You order something online, it hits your porch a few days later, and, well, you probably break down that corrugated box and toss it in the recycling bin without a second thought.
Right. It's just trash to most people.
Exactly. It is the ultimate invisible commodity. But if you want a real-time pulse on the global economy, if you want to know exactly how confident consumers are, or how aggressively supply chains are shifting, you don't necessarily need to look at complex derivative markets.
Yeah, you really don't.
You just need to look at the box. And right now, the biggest box maker in the world, International Paper, is flashing a massive paradox in their Q2 2026 financials. So, okay, let's unpack this.
Let's do it.
Because they are reporting a net sales figure of $6 billion, which is down year over year but up sequentially from Q1. They've got an adjusted EBITDA of $587 million and an adjusted operating EPS of 4 cents.
Right. Pretty standard headline numbers so far.
But then, at the exact same time, they posted a $12 million net loss from continuing operations. And they did that despite generating $526 million in cash from operating activities. I mean, it is just a wildly bifurcated earnings print.
It really is. And, it perfectly illustrates why relying solely on net income is incredibly dangerous when you're evaluating a mature industrial company.
Especially one going through a massive structural transition, right?
Exactly. That $12 million net loss, it's heavily distorted by significant non-cash accounting charges. I mean, depreciation and amortization were nearly $500 million this quarter alone.
Wow.
Yeah, and that's along with some really severe restructuring costs. But when you look at the actual liquidity being generated by the core business, well, that $526 million in operating cash flow tells you the underlying engine is still throwing off serious capital.
Which is the number that really matters at the end of the day.
Right. And you're absolutely right to look at this company as a macroeconomic bellwether. Before a product can be sold or shipped or consumed, somebody has to make the packaging for it.
Right. The box has to exist first.
Exactly. Corrugated box volumes are essentially a real-time proxy for macroeconomic health. If those volumes are up, goods are moving and the consumer is spending.
Which makes their capital allocation strategy right now absolutely fascinating. To figure out how they are managing to throw off $500 million in cash while transforming the entire corporate structure, you really have to follow where they are deploying that capital.
And right now, the vast majority of it is pouring directly into their North American operations.
Yeah, the PSNA segment, so Packaging Solutions North America, it's the undisputed profit center of the company right now. They pull in $3.688 billion in sales and $204 million in operating profit.
It's a massive segment.
It is. But the volume metric is what really caught my eye here. Box volume in North America is actually up 1.7% year over year. And management is explicitly projecting they will outpace the broader industry by about 2% for the full year.
That is massive in the packaging space. I mean, a 1.7% volume increase might sound incremental if you're looking at, software growth rates.
Right. Tech numbers spoil us.
Exactly. But in heavy industry, that is serious momentum. It means they aren't just riding a generalized economic tailwind. They are actively stealing market share from competitors.
And they're doing it entirely through operational efficiency, right? Because mill performance in North America improved by 5% year over year.
Yep, and that is a direct result of their rigorous 80-20 strategic approach.
I want to dig into the mechanics of that 80-20 strategy, actually, because it looks less like standard corporate cost-cutting and more like a total re-architecting of a logistics network.
That's a good way to put it. They are systematically analyzing their entire portfolio. They identify the 20% of their assets and customer relationships that generate 80% of their margin, and they ruthlessly optimize or divest the rest.
We talk a lot about pruning a tree in business, but with International Paper, it's highly geographical. I mean, paper is incredibly heavy.
Oh, very heavy.
And freight-to-margin ratios are notoriously tight in this industry. You do not want to be shipping massive rolls of containerboard across the Rocky Mountains on diesel trucks. It just destroys your margin.
It completely eats your profit, yeah.
So you see them acquiring the NORPAC facility in Washington State to serve the West Coast, while simultaneously opening a new Waterloo Greenfield plant and buying a facility in Dover, Delaware.
Exactly. That NORPAC acquisition, it is a masterclass in localized optimization. The West Coast market has a surging demand for lightweight, high-performance packaging grades.
Because e-commerce logistics demand lighter boxes, right? They want to save on their own shipping costs.
Precisely. And end users have strict sustainability targets now, too. So by acquiring a facility already positioned on the West Coast that can produce these subthissic lightweight grades, International Paper eliminates the transcontinental freight drag entirely.
They just don't have to ship it across the country anymore.
Right. They capture the premium margin of the lightweight product and simultaneously lower their distribution costs. It's a textbook 80-20 move. You take capital out of underperforming, isolated mills, and you deploy it into highly targeted regional assets.
So what does this all mean for the immediate bottom line right now? Because management noted they've identified over $210 million in run rate footprint and headcount savings.
Right, and about half of those asset changes are already completed.
But despite saving all this money, and despite mill performance jumping 5%, North American adjusted EBITDA actually dropped sequentially. It went from $477 million in Q1 down to $425 million in Q2.
Yeah.
So where is that operational leverage bleeding out?
Well, if we connect this to the bigger picture, you have to look at the maintenance schedule and the input costs. Those heavily suppress those operational wins this quarter. Q2 was a severely front-loaded quarter for capital expenditure and downtime.
Okay, so they were spending heavily on the mills.
Yeah, they executed a 2 times normal planned maintenance schedule, and that included taking the massive Riverdale machine offline for its conversion. The cost of those planned outages was a $127 million direct drag on EBITDA compared to the first quarter.
Wow, $127 million just from turning the machines off.
Exactly, because when you take a primary machine offline, you aren't just paying for the maintenance, you are eating the opportunity cost of lost production volume.
And they were battling macro headwinds on the input side simultaneously, right? They cited higher costs for OCC recycled corrugated containers and elevated freight costs tied directly to diesel fuel pricing.
Precisely. The open market price for OCC has been very volatile, and when your freight and raw material inputs spike in the exact same window that your production capacity is artificially constrained by planned maintenance, well, your margins compress violently.
That makes sense.
But the key takeaway for the North American segment is that this compression is temporary. It's structural. The maintenance is done, the Riverdale conversion is completed, and that $210 million in permanent run rate savings is now baked into the system.
So the foundation is highly optimized for the future.
Exactly.
Which provides a really jarring contrast when we pivot to what is happening across the Atlantic. Because while North America is taking market share and optimizing a highly profitable logistics network, International Paper is actively preparing to physically split the company in half.
Yeah, the EMEA segment, Europe, the Middle East, and Africa.
It is a completely different landscape, and the financials are, frankly, brutal right now. In Q2, EMEA posted $2.287 billion in sales, but they recorded an operating loss of $80 million.
It is a radically different operating environment over there. The management deck explicitly characterizes the European market as soft. It's driven by intense geopolitical uncertainty and deeply depressed consumer sentiment.
And when the consumer stops buying durable goods, the demand for the boxes to ship those goods just evaporates.
Exactly. And that lack of demand triggers a very specific mechanical trap in the packaging industry. It's the contract lag margin squeeze.
Right, because the open market price for raw paper, the containerboard, has actually increased in Europe. But because consumer demand is so weak, International Paper cannot immediately pass those higher raw material costs down to the end customers buying the finished boxes.
What's fascinating here is the rigid mechanics of these commercial agreements. Box contracts are typically indexed to raw paper prices, but with a built-in delay. It's usually 3 to 6 months.
So you're locked in.
Yeah, you can't just hike the price of a finished box on your major enterprise customers overnight. You have to wait for the contract to reset at the end of the quarter or half year.
So International Paper is absorbing the inflated cost of the raw paper today, but they are still selling the finished box at yesterday's price.
That timing mismatch is precisely what is driving that $80 million operating loss.
But despite that $80 million bleed, they are still pouring massive amounts of capital into European infrastructure. I mean, they're building a new recycled paper machine at the Lucca mill in Italy.
Right. Engineered for lightweight paper and drastically lower energy and water consumption.
And they are executing footprint optimizations in Germany to slash fixed costs. And looming over all of this is the impending spinoff.
Yeah. They are progressing exactly on schedule to separate North America and EMEA into 2 completely independent public companies. They're already identifying all the transitional service agreements to cut the cord.
I have to push back on this strategy, though.
Okay, lay it on me.
If you look at the raw data an $80 million operating loss, a severe margin squeeze, cratering consumer sentiment, and massive geopolitical headwinds. Isn't spinning off the EMEA segment right now just a sanitized way of dumping a toxic asset to protect the North American balance sheet?
Yeah.
I mean, it feels like they're throwing the European business overboard while it's taking on water.
That is the natural skeptical read, for sure. But when you examine the unit economics of what they're actually building in Europe, this is a calculated long-term play. It's not a fire sale.
Also,
Well, you mentioned the Lucca mill and the footprint consolidation in Germany. What management is doing is aggressively lowering the structural break-even point of the entire European operation. Energy costs in Europe have been devastatingly volatile due to the geopolitical situation.
right, the conflict there has made energy markets a nightmare.
Exactly. So by modernizing mills to consume significantly less energy and by successfully securing government subsidies to offset regional energy costs, they are structurally insulating the business from macro volatility.
So they are building a leaner ship before they set it adrift.
Exactly. North America and Europe have wildly divergent capital needs and market dynamics. Under the current structure, the European team has to fight for internal capital against highly profitable North American projects.
Which they are probably losing right now, given the numbers.
Right. So by uncoupling them, the EMEA management team gains the agility to focus entirely on the European macro environment. And crucially, they are timing the spinoff for the eventual margin snapback.
The snapback from those contract lags.
Yes. Once those commercial box contracts finally reprice to reflect the higher paper costs, and once European consumer sentiment stabilizes, the newly independent EMEA entity will have a radically lowered cost basis and fully restored pricing power. The margin expansion potential is massive.
Okay, that structural separation makes a lot more sense when you frame it around capital agility. And speaking of margin expansion, that leads us directly into the most aggressive and scrutinized part of this entire earnings release. The second half guidance for 2026.
Oh, yeah. Management is not just predicting a recovery. They're guiding for an absolute explosion in profitability.
The financial guidance is incredibly steep. I mean, for Q3, they're guiding for adjusted EBITDA between $780 and $830 million. But for the full year, they're projecting a staggering $3.20 to $3.4 billion.
To hit the midpoint of that full-year guidance based on where they exited Q2, they need a monumental acceleration in earnings over the next 6 months.
And here's where it gets really interesting. They aren't just projecting a vague hockey stick recovery. They provided a highly granular bridge showing the exact operational levers they are pulling to generate this cash. Yeah, they laid it all out. They are mapping out a $600 million earnings step-up in North America in the second half and a $170 million step-up in EMEA. When you look at the mechanics of this bridge, it functions less like a prediction and more like a coiled spring. The tension has been building for 6 months, and the second half of the year is when they finally release it onto the balance sheet.
I like the coiled spring analogy because the variables driving this step up are largely within management's direct control. Let's break down that $600 million North American bridge.
Sure, let's look at the pieces.
The largest component is a $380 million surge driven by price, volume, and mix. This is the mechanical realization of price increases they have already successfully implemented in the market as of June.
Right, because of that contract lag we talked about earlier, the higher prices are now legally gypped into the contracts, and as the back half of the year brings higher seasonal shipping volumes for the holidays, that new pricing flows directly to the bottom line.
Precisely. The heavy lifting on pricing is already done. They just need the calendar to turn.
That's $380 million right there. What's next?
Then you have a $150 million benefit purely from the timing of maintenance outages. Because they front-loaded all that heavy 2 times normal maintenance into Q2, their second half maintenance schedule is incredibly light.
So they aren't doing anything new to earn that $150 million. It is simply the absence of a Q2 negative acting as a Q3 positive.
Exactly. And then you layer on the operational wins. They project $120 million flowing in from those 80/20 initiative, the headcount reductions and network optimizations, plus another $100 million solely from the Riverdale conversion ramping up to its full optimization rate. The capacity is finally online.
But they do have some macro headwinds built into this, right?
Yeah. They do. They are realistic about the macro environment. They explicitly model a $150 million drag from macroeconomic factors, specifically diesel, natural gas, distribution, and escalating employee medical costs.
But even after eating that $150 million macro hit, the operational leverage still nets out to a $600 million expected surge in North American EBITDA.
And it is worth noting a very specific, localized headwind they factored into Q3, an $85 million negative impact from a temporary mill closure in Pine Hill, Alabama.
Okay, so they have entirely baked that localized disruption into the near-term guidance.
Yeah, which adds credibility to the broader projections. Over in EMEA, that coiled spring dynamic is heavily reliant on the $170 million step-up, with $110 million of that coming strictly from commercial improvement.
Which brings us right back to the contract lag again. Management is betting the house that the flow-through of prior paper price increases will finally hit those European customer box contracts in Q3 and Q4, effectively ending the margin squeeze.
Right. But this raises an important question. As mathematically airtight as management makes this bridge appear on a slide deck, these are forward-looking projections built on assumptions about global stability.
Yeah, and you always have to read the fine print.
Always. The company outlines a minefield of exogenous risks that could snap that coiled spring right back in their faces.
The geopolitical caveats in this report are actually quite stark. They explicitly state that these projections assume no further material escalation in geopolitical volatility.
And they're highly exposed to the military conflicts in Russia and the Middle East.
They also specifically call out the risks of protectionist trade policies, new tariffs, and retaliatory trade actions against the United States.
And this is where the European strategy is particularly vulnerable. If energy prices in Europe spike again due to an expansion of the conflict in the Middle East, or if global supply chains get choked by new aggressive tariff regimes, that $170 million EMEA step-up based on contract repricing could just vanish instantly.
The macro environment has to cooperate for them to execute this bridge.
It really does. They have pristine control over their internal operational leverage, the mill efficiency, the maintenance schedules, the footprint consolidation. But their top-line revenue remains deeply tethered to macro forces entirely outside of their control.
Which brings this entire financial narrative full circle. International Paper is executing a massive, high-wire corporate pivot.
That's exactly what it is.
They are systematically shedding underperforming assets, acquiring highly targeted regional infrastructure to optimize their freight networks, absorbing the heavy hits of planned machine outages, and executing the complex legal and operational groundwork to cleanly cleave a multi-billion-dollar enterprise into two independent public companies.
Right. And they are attempting to execute this entire structural transformation while simultaneously projecting a massive profit surge in the final 6 months of the year.
It is one of the most ambitious corporate transformation agendas in the industrial sector right now.
If management can actually deliver this second half step up in North America and successfully spin off a structurally leaner, margin-ready EMEA business right as the European macro stabilizes, it will be studied in business schools as a masterclass in 80-20 capital allocation.
So we'll leave you with this final thought to mull over. We noted earlier that International Paper expects to outpace the North American industry, showing a 1.7% bump in box volumes, while simultaneously reporting a heavily depressed European market tied to poor consumer sentiment.
Yeah, a real tale of two continents.
Exactly. We spend so much time analyzing complex GDP reports or inflation indexes to understand where the economy is heading. But what does the diverging demand for the humble corrugated box tell us about the trajectory of the global economy?
It tells you a lot. The massive capital deployment in North America versus the structural insulation and spinoff in Europe tells a very clear story about where corporate America believes the consumer strength actually lies.
Next time a package lands on your porch, don't just think about what's inside it. The box itself is a real-time economic indicator sitting right on your welcome mat.
The logistics network behind that cardboard is literally mapping out global demand.
Thank you so much for joining us for this deep dive. If you want to keep tracking these specific structural shifts and get ongoing daily earnings coverage, make sure to hit that subscribe button to follow the show. We'll see you next time.